Welcome to the Deep Dive. We're here to cut through the noise of those dense financial headlines.
That's right.
Have you ever looked at a company's quarterly report, seen the numbers, and just wondered, what does this really mean for the company's future? Or, for me as an investor.
Absolutely. That's exactly what we're doing today.
Today, it's all about Maxis.
Yep. We're doing a deep dive into Max's Q2 2025 quarterly report. We'll look back a bit, compare it, see the trends.
And really unpack what these numbers signal about where they're headed, their competitive edge, that sort of thing.
Exactly. Our mission here is simple. Give you a clear, straightforward, friendly understanding. Doesn't matter if you're a seasoned pro watching every market tick or just starting out.
So what's on the table for today's deep dive?
Okay, so we'll kick things off with the big headline numbers from Q2, the key financial highlights.
Then we'll get into the weeds a bit. Where's the money coming from? Revenue streams, subscriber trends, what's happening with their customers.
And then a big one this quarter, it seems, their cost management. It sounds like they've been pretty impressive there.
Yeah, that profit jump with flat revenue definitely points that way.
Right. And we'll wrap it all up by tackling this fascinating idea of a financial moat. What actually protects Maxis, in this really competitive telecom world?
Sounds like a packed agenda.
Yeah.
Let's jump right in. Where do we start? The headlines.
Let's do it. So the big picture for Q2 2025, Maxis reported a net profit of RM 398 million.
Okay.
That's up a solid 11.8% compared to Q2 last year. So strong profit growth.
11.8%. That's pretty healthy.
It is. But here's the interesting part we hinted at. Despite that profit jump, their overall revenue actually eased back slightly.
Eased back by how much?
Down 0.9% year on year, landed at RM 2.56 billion for the quarter.
Okay, so less than 1% down on revenue, but almost 12% up on profit. That is interesting.
It really sets the stage, doesn't it?
Does this pattern hold if we look at the first half of the year, say the first 6 months of 2025 compared to 2024?
Good question. And yes, pretty much. Zooming out to the first half, 1H 2025, the net profit totaled RM 769 million.
Which is up?
Up 8.5% compared to the first half of 2024.
Okay, still strong growth and revenue for the half.
Again, marginally lower, came in at RM 5.17 billion for the 6 months.
So the story holds, Maxis is definitely making more profit, but it's not coming from selling more stuff overall, at least not in terms of total revenue value.
Precisely. It points towards efficiency, cost control, something internal driving that bottom line.
Right. Now, something crucial for many investors, dividends. What's the news on that front?
Good news for income seekers. Maxis declared a second interim dividend. It's a single-tier, tax-exempt dividend of 4 cents per share.
Payable when?
It's set to be paid on September 25th, 2025.
And does that bring the total for the year so far?
Yes, that brings the year-to-date total to 8 cents per share, which actually matches what they paid out in the first half of last year.
So consistent dividends. What's the payout ratio looking like?
Around 79%.
Yeah.
Pretty standard for them, returning a good chunk of profit to shareholders.
Okay. So we've got this picture. Strong profit, slightly softer revenue, consistent dividends. How did the market analysts react? Were they expecting this? Surprised?
The sentiment was generally positive, but maybe a bit mixed in terms of ratings, though everyone seemed to spot the same core driver.
Which was?
Cost management. Ammon Investment Bank, for example, called it no surprises. They kept their buy rating, target price, RM 4.20. That implies, about a 28% upside from where it was trading?
And they pointed to costs.
Yeah, they specifically highlighted that the 9% core earnings growth in the first half was, and I quote, largely driven by cost savings.
Okay, one view. Any others? Diverging opinions?
Well, RHB saw it as a slight beat on earnings. Their take was OPEX excellence, that's operational expenditure, basically cost control again.
Right.
They gave it a neutral rating, though. Target price RM 3.72, about 8% upside, so less bullish than Ammon Investment.
Interesting. Anyone else?
TA Research said the results were within expectations. They maintained a hold rating, target price RM 3.68, just over 3.5% upside there.
So a range from buy to hold, but everyone's seeing the cost angle.
Definitely. Even Business Today went a headline like, Maxis gains from lower cost management. They called it an earnings beat, driven by, yes, lower costs, but also mentioned higher service revenue, which needs a bit of unpacking.
Okay, so the consensus is clear. Efficiency was key. But that still leaves the puzzle. How did they manage that profit jump while overall revenue dipped?
Right.
This brings us squarely to the revenue side. Where is Maxis making its money? What's actually happening with their customer base? Let's unpack that service revenue comment.
Yeah, let's dig in. So if we look specifically at service revenue, that's revenue excluding things like selling phones, device sales.
The core telecom services.
Exactly. That actually declined marginally, down 0.7% year-on-year in the first half of 2025. Came in at RM 4.38 billion.
Okay, so service revenue also dipped slightly. Why? Is demand weakening?
Well, not necessarily. The sources explain this. It's mainly down to two specific things. First, a new commercial agreement for their Maxis Safe Device program.
The device insurance thing.
Yeah. And under the new agreement, they recognize the revenue differently on a net basis. So it looks lower on the books even if the underlying activity is similar.
An accounting change. That can definitely muddy the waters year on year. What's the second thing?
Reduced regulated interconnect rates. That's the fee telcos charge each other when calls connect between networks. Regulators lowered those rates.
Okay, so accounting and regulation, not necessarily fewer people signing up or using services less.
That seems to be the case. Crucially, the reports suggest if you normalize for these factors, adjust for the safe device accounting, and the interconnector rate's service revenue would have actually shown a slight increase.
That's a really important nuance. It shows how headlines can be misleading without context. It makes comparing performance tricky for investors if they don't dig deeper.
Absolutely critical context. Okay, so let's move into the consumer segment. This is where most of us interact with Maxis, right? Mobile plans, home internet.
How did that segment do overall?
It saw a slight decline overall, 1.0% year-on-year in Q2, down to about RM 1.8 billion. And for the first half, a similar 1.4% decrease. Again, largely attributed to that safe device program and the interconnect rate changes we just talked about.
Okay, so the same factors impacting the consumer division. Let's break it down further. Postpaid, the contract plans. How did they fare?
Postpaid actually looked pretty good on the surface. Revenue increased 1.9% year-on-year in Q2, hitting RM 933 million.
And subscribers, are they still adding postpaid customers?
Yes, definitely. Subscriber numbers kept growing, up 1.5% just from the previous quarter, reaching 4.04 million in Q2. And compared to last year, a significant 10.1% jump year-on-year, bringing them to over 5.6 million subscriptions.
Wow, 10% growth in postpaid subscriptions year on year. That's strong.
It is impressive growth in customer numbers, no doubt. But, and here's the nuance again.
There's always a but.
There often is. The average revenue per user ARPU for postpaid, basically how much each customer spends per month, that dipped slightly, down 0.7% compared to the previous quarter to RM 71.3. But more noticeably, it was down 5.2% compared to the same quarter last year.
Down over 5% year on year. Why, if they're adding customers?
It seems to be partly due to customers migrating from prepaid plans to postpaid, often onto maybe cheaper entry-level postpaid plans.
Okay.
And also the growing popularity of family line plans. Yeah. You add more lines, but the average revenue per line comes down.
Got it. So more customers, but each one, on average, is bringing in a bit less money. It's like filling a restaurant, but everyone's ordering the appetizer special.
That's a good analogy. It puts pressure on overall revenue growth, even if your customer count is rising.
Definitely something to watch. What about the other side of mobile prepaid?
Prepaid continued to face pressure. Revenue there declined 5.9% year-on-year in Q2, down to RM 610 million.
And subscriber numbers.
A slight decrease there, too, down 0.4% from the previous quarter to 5.77 million, and down 0.8% compared to last year.
So fewer prepaid customers and lower revenue. What about ARPU for prepaid? Did that also fall?
Interestingly, prepaid ARPU actually improved slightly quarter-on-quarter, up 2.9% to RM 35.3. That might be due to some seasonality or maybe some targeted offers they ran.
Bump up.
Yeah, quarter-on-quarter. But compared to last year, it was still down quite a bit, 7.3% year-on-year.
Wow, down over 7% year-on-year. That really signals how tough the prepaid market is, doesn't it? Lots of competition, price wars, maybe.
It certainly points to a very competitive environment, yes. Intense pressure on pricing.
Okay, so mobile is a mixed bag. Postpaid, growing subscribers but lower ARPU, prepaid, shrinking revenue, and ARPU pressure. What about home connectivity, fiber internet? That seems like a growth engine for telcos.
And it was for Maxis. Home connectivity showed strong growth. Revenue was up 13.4% year-on-year in Q2, reaching RM 254 million.
13% growth, nice. Connections.
Connections also grew, though more modestly. Up 0.1% quarter-on-quarter and 1.4% year-on-year, hitting 788,000 connections.
Yeah, the ARPU for home. Did that hold steady?
Yes. Remarkably stable, remained flat compared to the previous quarter at RM 110.2, and no change year-on-year either.
So home fiber is a reliable grower, contributing nicely. It seems their strategy of bundling mobile and home, creating that converged offering, is working to some extent.
It looks that way, yes. It helps offset some of the mobile pressures.
Okay, that covers the consumer side. Now let's shift gears to the enterprise segment businesses. How did Maxis perform there? This is often seen as a more stable, higher value market.
And it really stood out this quarter. The enterprise segment was a definite growth driver. Revenue increased 1.5% year-on-year in Q2 to RM 407 million.
And for the first half.
Growth there too, up 2.2% in the first half to RM 805 million. Healthy growth.
What's driving that growth in enterprise?
It seems to be coming from a few areas. Increased mobile subscriptions for businesses, so signing up more corporate mobile plans. Also, higher wholesale services selling capacity to other providers. And they mentioned strong project deliveries for fixed line services and other business solutions.
So it's quite broad-based growth within enterprise. That's encouraging.
Very much so. It's clearly a key pillar for them moving forward, picking up some of the slack from the more pressured consumer mobile side.
Right. This all circles back perfectly to our first observation.
Okay.
Profit up significantly, revenue more or less flat. It absolutely has to mean their operational efficiency, their cost management is running exceptionally well.
Exactly.
Let's talk about that power of cost management. This feels like the real secret sauce for Maxis in Q2.
I think that's fair to say. Let's look at EBITDA earnings before interest, tax, depreciation, and amortization. It's a core measure of operational profitability.
How did that look?
It grew a healthy 4.6% year-on-year in Q2, hitting RM 1,094 million, so just over a billion ringgit. For the first half, it was up 2.8% to RM 2.15 billion.
So solid growth in underlying operational profit. And this was mostly cost-driven, as the analysts said.
Overwhelmingly, yes. That significant earnings uplift came primarily from managing costs better.
Okay, cost-driven can sound a bit vague sometimes. Can you give us more concrete examples? How did they actually pull this off? Was it just, squeezing suppliers harder or something more strategic?
It seems like it was more than just simple belt-tightening. The reports point to some pretty strategic moves. For instance, successful negotiations with manufacturers.
For what? Devices, equipment.
Both, likely. Securing more favorable terms for key products. Think about getting a better price on every smartphone they bundle or sell, or better rates for the gear that runs their network. That directly led to what they call improved device subsidy optimization.
Meaning they spend less subsidizing phones for customers?
Effectively, yes. Or get better value for the subsidy they provide. But it wasn't just that. They're also making a big push on digitalization and AI adoption.
Using technology for efficiency.
Exactly, to unlock further, more systemic cost savings. They mentioned seeing early successes using AI in areas like collections, for example, streamlining processes that used to be really labor-intensive and expensive.
That's smart. It's not just cutting costs for today, but building a leaner operation for the long run using technology.
Precisely. It's about structural efficiency, not just temporary cuts.
And how did this focus on efficiency show up in their margins? Did profitability improve?
Dramatically. The EBITDA margin on service revenue specifically, which is a key metric, expanded notably. It hit 49.6% in Q2 2025.
Wow, almost 50%. What was it before?
It was 47.2% in Q2 2024, so that's a significant jump of over 2 percentage points in a year.
That clearly shows how effective that cost management has been, turning more of that service revenue into actual operating profit.
Absolutely. It's a direct measure of that efficiency gain.
Okay, so they're being really smart with their operating costs. But what about the big investments? Capital expenditure or CapEx, the money spent on building and upgrading their network, their fiber, all that infrastructure, are they cutting back there too?
Actually, no. CapEx went the other way. It increased 42.2% year-on-year in Q2, reaching RM 165 million.
Increased. Quite a jump.
It is. And for the first half of the year, CapEx was up 13.1% year-on-year to RM 251 million.
So they're spending more on infrastructure, not less. Is this a sign of maybe inefficient spending, or is it strategic?
It appears very strategic. This isn't about lax spending. It's about investing for the future. Management actually lifted their full-year CapEx guidance.
Oh, they plan to spend even more than initially thought.
Yes. They now expect it to be approximately RM 1 billion for the full year. Previously, the guidance was just below RM 1 billion.
And where's that extra investment going?
It reflects ongoing necessary investments in upgrading their mobile network, think 4G improvements, preparing for more 5G. Also, expanding their fiber network in key strategic areas, essentially future-proofing their whole integrated network. You have to spend money to stay competitive in this industry.
That makes sense. You can't just cut costs everywhere, especially on the core infrastructure and tech.
Mm.
But, okay, if CapEx is up, what does that do to their cash flow? Specifically, operating free cash flow, OSCF, the actual cash left over after running the business and making those investments.
Good point. OFCF actually showed improvement quarter on quarter, up 5.2% to RM 929 million in Q2. So healthy cash generation from operations in the quarter itself.
But compared to last year.
That's where the higher CapEx bites.
Yeah.
OFCF declined 8.6% year on year in Q2, and for the first half, it was down 3.3% year on year.
And that dip is mainly because?
Mainly due to that higher capital spending we just discussed. Plus, they mentioned increased regulatory payments also impacting cash flow.
Okay, so the takeaway is generating good cash from operations, but reinvesting more back into the business for future growth and meeting regulatory dues, which means less free cash flow left over right now.
That sums it up well. They're optimizing current operations brilliantly while actively investing for what's next.
Speaking of what's next, let's broaden our view now, move into the strategic landscape, the future outlook. 5G development has got to be front and center here, right?
Absolutely critical. Maxi has a significant stake, 19.44% in Digital National Berhad, or DNB.
DNB being the government's special vehicle for the national 5G rollout.
That's the one. And Maxis is actively involved in discussions about the second 5G network rollout. There's a plan for 2 competing 5G networks eventually.
Right, and they just put more money into DNB recently.
Yes, along with the other major telcos. They participated in a capital injection, RM 117 million each, into DNB, so they're financially committed.
That sounds complex. A big commitment, lots of moving parts with DNB and the second network. What are the potential risks here? This 5G transition seems fraught with uncertainty.
It definitely is. The sources flag several key risks. One is simply heightened execution risks on 5G rollout. Rolling out a new generation of technology nationwide is complex and expensive.
Makes sense. What else?
There's the possibility DNB might need more funding, more advances, which means operators like Maxis might have to chip in more capital than planned.
Okay, a financial risk.
And then there's the competitive threat, the risk of a potentially superior second 5G network being rolled out by competitors. The example given was U-Mobile possibly partnering with giants like Huawei and ZTE.
So Maxis invests in DNB, but a competitor could potentially build something better or faster.
That's a risk, yes. And maybe the biggest structural change, the move to a wholesale 5G model, at least initially via DNB. This inherently implies reduced pricing power for players like Maxis, because they're essentially buying capacity from DNB and reselling it rather than having full control over their own 5G network infrastructure and the pricing related to its unique capabilities. It sort of commoditizes the underlying network layer.
Reduced pricing power. That's a major long-term concern for any business, especially in a competitive market. Okay, besides 5G, what about bigger strategic moves, mergers, acquisitions? Anything cooking there?
Well, there's persistent talk about Maxis exploring a potential acquisition of U-Mobile.
Buying U-Mobile, that would be a huge consolidation.
It would. It could offer significant synergies, obviously, combining customer bases, networks, maybe getting enhanced spectrum access. It would really consolidate the market.
But wouldn't regulators have something to say about that? Reducing the number of major players.
Absolutely. That's the big caveat. It comes with potential regulatory risks. Regulators would scrutinize any deal very closely due to concerns about decreased competition. It's far from a done deal.
Right. Always a hurdle with big M&A and regulated industries. Any other regulatory headwinds on the horizon?
Yes, there's the sales and service tax, the SST. Its scope was recently expanded to include things like tower rental and leasing services.
Stuff telcos rely on heavily.
Exactly. And the estimates suggest this could impact Max's annualized EBITDA by around 1%. So another small but noticeable cost pressure coming from the regulatory side.
Okay, so we have these investments in 5G, potential M&A, regulatory costs. With all that going on, what's Maxis actually guiding for the full year, FY 2025? Have they changed their outlook?
Interestingly, no. Their full year 2025 guidance remains unchanged.
Which is?
They're still expecting a low single-digit increase in service revenue.
Okay, so modest growth there.
Flat to low single-digit growth in EBITDA. So expecting that cost efficiency to keep contributing, but maybe not at the same explosive rate as in Q2.
And CapEx.
CapEx spending expected to be around that RM 1 billion mark we discussed.
So overall, it sounds like a forecast for cautious but stable progress through the rest of the year.
That seems a fair assessment, yes. Steady as she goes while navigating these big strategic shifts.
And to navigate all this, they must have a clear plan. What are their main priorities for 2025?
They've outlined 5 key priority areas. Seems quite focused.
What are they?
First, strengthening consumer bundling and cross-selling. They actually call this building their consumer fortress. Keep those home and mobile customers locked in.
Okay, defensive play there.
Second, growing the enterprise business we saw that's already a bright spot. Third, continuing to build out infrastructure and wholesale services.
The foundation.
Fourth, accelerating that digitalization and AI adoption we talked about for more efficiency. And fifth, just overall operating with excellence across the board.
Sounds like a solid, if perhaps not revolutionary, strategic framework, covering the key bases.
It's a comprehensive plan aimed at maintaining their position as a leading integrated telco in a challenging market.
Okay, this brings us to a really interesting part of our analysis, the financial moat scorecard.
Yes.
Now, for listeners who might be new to this term, a financial moat, think of a castle moat, right? It's not water, but it's a sustainable competitive advantage, something that protects a company's long-term profits from competitors trying to storm the castle gates.
It's what gives a company pricing power, customer loyalty, resilience, keeps rivals at bay.
Exactly. So, considering everything we've discussed, the good, the bad, the challenges, what score does Maxis get? How strong is its moat?
Based on our analysis of the sources, Maxi earns an overall score of 7 out of 10.
7 out of 10. What does that translate to? Weak, strong.
We'd classify that as indicating a moderate to strong moat.
Moderate to strong. Okay. What supports that score?
It's well supported by things like its established premium market position, its really extensive physical infrastructure, that network is hard to replicate, and the operational efficiency it demonstrated this quarter.
But it's not a perfect 10. What holds it back?
It's tempered by the reality of the market. It's a highly competitive, mature telecom landscape in Malaysia, and the complexities and uncertainties around the 5G rollout definitely introduce challenges that could, test the strength of that moat over time.
Okay, a solid 7-10. Let's break that down. How do they score on the specific characteristics that build a moat? Let's start with intangible assets, things like brand, patents, licenses.
Here, Maxis scores very well, an 8 out of 10.
8, why so high?
Well, first, brand strength. Maxis is widely recognized as a premium brand, historically associated with network reliability and quality service. That counts for a lot.
True, brand matters.
What else? Their network infrastructure is a massive intangible or perhaps semi-tangible asset. 95% 4G population coverage, over 11,000 network sites, a 22,000-kilometer fiber footprint. Building that from scratch today. Hugely expensive and time-consuming.
There's a huge barrier to entry.
Definitely. Then there's their strategic 5G involvement, that 19.44% stake in DNB, their eligibility to potentially operate the second 5G network. That gives them a seat at the table and a potential edge, despite the risks involved.
Okay.
And finally, licenses. They hold substantial, valuable telecommunications licenses. The reports value these at nearly RM 9.7 billion plus spectrum rights worth another RM 920 million. These are essential, hard-to-get assets.
Right. You can't just decide to become a telco tomorrow. So 8-10 for intangibles makes sense. What about the second factor, switching costs? How hard is it really for customers to leave Maxis?
We rated this a 6 out of 10.
6. So moderate switching costs.
Yeah. It's not always a huge monetary cost, but there are frictions. The hassle of porting your number, maybe breaking a contract if you're on postpaid, learning a new provider's app or billing system, potentially losing bundled deals.
Consumer fortress strategy you mentioned earlier.
Exactly. Maxi's strategy of bundling mobile, home fiber, maybe device, plans it actively aims to increase that stickiness, make it more complex and less appealing to just switch one service.
Well, why only a 6? Why not higher?
Because ultimately, it is a mature and very competitive market. Number portability is mandated. Competitors are constantly offering aggressive deals. So while there are costs, they aren't insurmountable for many consumers if a competitor offers a compelling enough reason to switch.
Okay, fair enough. Next moat source, network effects. Does having more users make Maxis better for everyone?
Yes, network effects are definitely present. We gave this a 7 out of 10.
7. How does that work in telecoms?
Well, as Malaysia's second largest mobile operator, serving around 13 million customers across all segments, that sheer scale matters. A larger user base generally means more efficient network utilization, which can support better investment in coverage and capacity.
So more users justifies building a better network for everyone.
In part, yes. And more users can also make certain services more valuable. Think about calling or messaging within the same network, though that's less distinct now. But fundamentally, a large growing base, like their postpaid and home connection growth, makes the whole ecosystem more robust and attractive, potentially drawing in even more users. Size begets size to an extent.
Got it. Okay, fourth factor, cost advantage and operational efficiency. We talked a lot about this already. How does it score as part of the moat?
This also gets a strong 7 out of 10.
7 again.
Yes. Maxis clearly demonstrated this in Q2. That 9% core profit growth in the first half, driven largely by those successful negotiations with manufacturers and suppliers, that's a cost advantage.
Right.
And their proactive push into digitalization and AI isn't just about temporary savings. It's about building a structurally lower cost base for the future. That improved EBITDA margin on service revenue hitting nearly 50%. That's tangible proof of an efficiency advantage translating into profitability.
So being leaner and smarter than competitors is a moat source itself?
Absolutely. If you can deliver similar services at a lower cost, you have more room to maneuver on pricing or reinvestment.
No, makes sense. Okay, the final moat characteristic, efficient scale. How does Maxis score here?
We rated this a 6 out of 10.
6. I thought scale would be higher for a big player like Maxis.
Being a major player definitely provides advantages. Scale gives you better bargaining power with suppliers, tying back to cost advantage, efficiencies in marketing spend, and better utilization of that expensive network infrastructure across millions of users. Spreading fixed costs is key.
So why only a 6? What limits the scale advantage?
Mainly the market context. It's a mature mobile market, high penetration, and crucially, that shift towards a wholesale 5G network model, potentially with 2 competing national networks, that could actually lower barriers to entry for smaller players or mobile virtual network operators, MVNOs.
Oh, so?
If smaller players can just buy wholesale 5G access from DNB or the second network without massive infrastructure investment, it might erode some of the scale advantages the big incumbents like Maxis have traditionally enjoyed. It could intensify competition at the retail level.
Ah, okay. So the changing 5G structure could challenge traditional scale benefits. That's a really interesting point. So we have the 710 overall moat score built on strong intangibles, good network effects, and cost advantages, but maybe slightly less protected by switching costs and efficient skill due to market dynamics.
That's a good summary.
But moats aren't permanent. They can be eroded. What are the biggest risks or mitigating factors that could weaken Max's moat strength? What should investors really keep an eye on?
This is crucial. Maintaining a moat requires constant vigilance. First, just intense competition. We've said it before, but the Malaysian telecom market is mature and fiercely competitive. Constant pricing pressure, aggressive marketing, it chips away at everyone's defenses.
Always a factor. What else?
The 5G transition itself remains a major source of risk. Those heightened execution risks we mentioned, delays, cost overruns, the potential need for more DNB funding, tying up capital, and that looming threat of a superior competitor network emerging. Plus, the reduced pricing power inherent in the wholesale model could definitely squeeze margins over the long term.
So 5G is both an opportunity and a significant potential threat to the moat.
Very much so. Then there's the ARPU pressure we saw.
Right, the declining average revenue per user.
Yes, those noticeable year-on-year drops in both postpaid, -5.2%, and prepaid, -7.3% in Q2, are worrying signs for the moat. Remember that sensitivity. A 1% drop in ARPU can potentially hit earnings by 4%. If they can't stabilize or grow ARPU, it directly weakens their financial strength and pricing power.
That link between ARPU and earnings is stark, a key metric to watch. Any other major risks?
Finally, regulatory uncertainty is always a factor. That potential U-Mobile acquisition. It faces significant regulatory hurdles related to market concentration, and even smaller things like the expanded SST on tower rentals add cost pressure and show how regulatory changes can impact the business environment. These external factors can definitely affect the moat's defensibility.
Okay, that gives us a really comprehensive picture of Maxis's strengths and the challenges it faces in defending its position.
It's a dynamic situation.
So wrapping this all up, what does it mean for you, the listener, trying to make sense of Maxis? What are the key takeaways from this deep dive?
I think the main takeaway is that Maxis showed real resilience in Q2. Financial performance looks strong, but it's primarily driven by really impressive cost management right now, coupled with that strategic focus on stabilizing consumer and growing enterprise.
And the moat.
They clearly maintain a moderate to strong financial moat, a 7 out of 10 built on that powerful brand, their extensive infrastructure, and a large customer base.
But
The challenges are real and ongoing. The dynamic 5G landscape, intense competition, ARPU pressure, regulatory factors, these all demand constant strategic agility to protect that moat.
So understanding these underlying drivers, the cost savings, the ARPU trends, the 5G risks, the moat characteristics helps you look beyond just the headline profit number, right?
Yep.
It helps you appreciate the strategic game Maxis is playing to secure its future in a market that's changing fast.
Exactly. It's about seeing the levers they're pulling, the advantages they hold, and the pressures they face. It gives you a much richer picture than just the top-line figures.
All right, let's leave our listeners with something to think about. A final provocative thought.
Okay.
Given everything we've discussed, the relentless evolution of 5G, the massive push for AI integration, not just for cost savings, but potentially new services, and that persistent pressure on ARPU, how might Maxis need to evolve its strategies? Specifically, that consumer fortress idea and the enterprise expansion. How do they need to adapt those to truly cement their moat against this constantly shifting competitive landscape? How do they ensure adding customers translates into stronger, more profitable revenue, not just bigger numbers with shrinking margins?
That's the billion-dollar question, isn't it? Moving beyond defense to create new value in the 5G and AI era.
Something for everyone to chew on. That wraps up our deep dive on Maxis Q2 2025. Thanks for joining us.